In this webinar, we'll explore solutions to the retirement investor's problem of how to manage risk for the long term. We'll conclude that strategies that manage risk in response to actual performance, rather than solely on the basis of forecasts or time, deserve a prominent place among retirement investment options. Then we'll actually present a practical implementation of such a strategy that A&P in fact uses in managing some assets. Just a moment about us. Appreciation and Preservation Strategies, or A&P for simplicity, is an investment strategy research, development, and implementation company. But we focus solely on the issue of long-term investment strategy for investors that have major liabilities to be met at specific, but not necessarily exactly known times in the future. I'm John O'Brien, the young fellow on the left of your screen in the blue shirt, and I'm a managing partner of A&P Strategies and emeritus adjunct professor from Berkeley, where my activity was almost solely with the master's program in financial engineering, and secondly, looking at strategies that can bend the market to people's preferences as opposed to strategies that are trying to outwit the market. Also with me today is Miguel Palacios, who's a senior principal at A&P Strategies, and he's an assistant professor of finance at Vanderbilt. And Miguel is a graduate, PhD graduate from Berkeley. And Miguel's job in particular will be to answer any of the very difficult questions that I hope you will ask of us. Before I get into this, I want to ask Matt, who is a camera-shy colleague of ours, but who has been instrumental in putting this together, to tell you how you can ask questions or send written questions. Matt?
Okay, thanks, John, and I just want to say welcome to everyone. Thanks for attending our webinar today. We want to make sure that we address your questions, so we want to tell you about two ways that you can submit questions. So first, during the presentation itself, all listeners will be in listen-only mode, but at any time during the presentation, you can submit questions by typing them into the questions module in your GoToWebinar control panel. At various points throughout the presentation, John's going to pause. I'll read submitted questions that have been submitted in that way, and John and Miguel will answer them before moving on to the next session of the presentation. And then secondly, you'll at the end of the presentation, we'll have a question and answer period, and there you can either type in your questions as before, and I can read them, or if you have a microphone enabled or some other way to talk, you should see a little blue hand icon in your GoToWebinar module there. You can click on that to raise your hand, and when you do, then I'll unmute you so that you can verbally ask your question. So we'll do our best to get to all your questions during this time, but please know that you can always contact us either at contact@ampstrategies.com, or you can contact John directly by emailing him at john@ampstrategies.com. And if you didn't catch those email addresses just then, that's okay. Don't worry, they'll be on the on a slide at the end of the presentation. Okay, so thanks again, and with that, I'll hand it back to John.
Thank you, Matt. Let's look at what we see as the crux of the retirement investing issue. And I think it was most succinctly stated by the New York Times in an editorial, From Here to Retirement, back in 2009, where they said, people close to retirement don't have time for a do-over. Even for those still far from retirement, there's no telling how stocks will perform in the future. And I guess all of us in the investment business in particular understand how hard it is to know what's going to happen, particularly in the future. But the challenge, if we want to be specific and try to identify those issues which make this such a knotty problem, I would list the following, and you may have some of your own, and we'd be happy to hear about those as a written question or verbally later. But some of the characteristics of the retirement investor issue, which is so daunting, is number one, the horizons are very long. Typically, a new entrant into the employment market might see retirement 35 or 40 years into the future. Secondly, the investors have very diverse circumstances. Some may have some form of outside wealth. Others may depend solely on the investing that is able to be done with the savings that they are accumulating in their 401k or similar plans. The other very big unknown, of course, that we all face every day is inflation and market returns. They're highly volatile. Now in the United States, the average has been good, but the volatility has been very high. There are other nations which we could have been born into, in which the returns aren't high, and investing on a risky basis has produced the risk rather than the benefit. Then we have the investors themselves who have a set of expectations about how their investment is going to go, and they tend to be somewhat unrealistic. One is they seek safety when things are bad. They look for high equity returns when things are good. And thirdly, they tend to have a high watermark memory, which is to say that over, let's say, 35 years, if 20 years into the 35 years, their investments have gone from a small amount at the beginning, say 10,000, to $1 million, but then by the 35th year when they're retiring, they're down to 700,000. Rather than say, gee, I've really done well over 35 years, they say, gee, I've really gotten hit badly over the last 10. So in addition to everything else, we have the issue of keeping track of fall from the high water mark, as well as trying to have a high water mark. So what might the ideal solution look like? Well, it would have several features. Clearly, protection in poor markets, gains in good markets, some form of high water mark lock-in in fluctuating markets. Two others which perhaps are somewhat away from the specific investment issues, but more to the individual, is the idea of the artificial maturity that a target date sets up. Although we might like to think we're going to retire at some point 35 years in the future, to build an entire plan around that would seem a little bit foolish at this point. And then lastly, clearly, whatever we come up with, it's got to be understandable to the typical investor who would be using it, and it's got to be implementable to the investment concern that's going to be creating it. There's no doubt that to date, the most successful and extremely successful strategy to deal with this issue has been the Glidepath target date strategy. We know that many funds that have been set up on this basis, they all have a characteristic of starting high in equity commitment and gliding down to a low equity commitment. But where they start, where they end up, how rapidly they transition is different among the many different plans. And what the active asset is also different. But how can we get a handle on exactly what these plans are really doing for people? Let's begin by being as simple as we can, sort of a back of the envelope look, and take, say, a 10-year period in a representative glide path, which is kind of extreme, but it will illustrate better the points. A glide path which begins 100% in equity and falls, 10% each year till it begins the 10th year with 10% in equity. So this is kind of a canonical form of a glide path. And to see what it is doing, let's look at two potential return streams over these 10 years. And these two return streams will have the same total return, the same volatility of return, the same likelihood of occurring, and they're shown at the bottom of this slide. One begins with a poor set of years, 2% in year one, 4%, 6% on up to the 10th year, 20%. The other is simply the mirror image of that, 20% initially down to 2% in the 10th year. So the characteristics are exactly the same, they're just reversed. So what would it look like if you were going in one of these markets or the other with this glide path? If you started into a market which was very good at the beginning and poor at the end, then you'd see your track would be that of the red path. Your $1 initially goes up to about $2.50 at the end of 10 years. If you go into the environment which begins with low returns and builds up, you're in the blue or purple path, in which case you're going to end up with less than $2. So with exactly the same characteristic market, you get a markedly different outcome. Now you might say, well, what if I just took the average and kept the average all the time rather than gliding down a path? Well, if you took a fixed 50-50 mix, for instance, you'd have a result, in this case, a little over 2. But the benefit of that would be to you that regardless of how you got through this period, you would have a known outcome. In other words, the sequence of how you go through life is not important. How successful the markets have been, of course, will be important, but how they got that way would not be important to you. Now, we all know there are more than 2 ways the future can evolve, and many of us have faced this issue, and the standard way to deal with a lot of uncertainty in the future is to do a simulation. One philosopher who I read recently, tongue-in-cheek, said doing simulations is like remembering forward. So we do have to realize that even with 100,000 simulations, which we will do, we are in some sense, unless we deliberately do otherwise, we are recreating the past in some way, not exactly how it was, but with the same statistical characteristic. So the simulation effectively is going to allow us to create many futures, all of which have the same underlying character. And depending on how we choose the distribution which will generate these futures, we will be able to say something different about how robust they are. But typically, one creates the distribution from the past, some actual specific past. And in the US, we typically use the US past. And you know, we now have a very long past, so we have a lot of statistics. But we do recognize that all those statistics come from a period of time which has been rather unique in the long history of the world in terms of being good almost everywhere, and particularly good in the United States. So we will generate lots and lots of potential futures, and if we could sort through them, we would actually expect to find the future that exactly equals the past that set up this whole process. So if we plotted what we got out of these simulations, we would see something like you see here. You may have seen pictures like this before. So these are the possible futures that all generate from one specific past. And we might look through this, we might actually be able to find that specific past. But I don't think we have time for that now. At any rate, this is what is going on. The question is, how do we digest it into something that might be analyzable? So if you look down the right-hand side of this picture, these are all the ending values of the various simulated futures. And we could create a distribution or a histogram of those points along the right-hand side of this picture. And it would look like what we see here in blue. So the histogram that we've created is from 100,000 simulations of a 35-year period in which the glide path began with about where the average glide path in current programs begins at 80% and goes down to 20% at the beginning of 5 years before the 35th year. So every 5 years, the equity commitment is going to be diminished by an equal amount until you go from 80 down to 20. And so a particular mix is actually held for 5 years, but rebalanced on a monthly basis. So this is what you would look forward to. Now that's pretty diverse, as you can see, pretty spread out. And it would be rather difficult to project how you might live in retirement from something like this. So you might say, well, what impact has this glide path done on this uncertain future? Well, one way to get a handle on that might be to take a different glide path and see what it does. So let's take not just a different one, but let's take the exact opposite one, namely a glide path that begins with 20% in equity and ends up with 80% in equity, the exact converse of what we see here in blue. And I want to show you the distribution of that glide path. But before I do, I want to take 10 seconds for you to imagine what you think it will look like. How different from this histogram do you think the histogram of 100,000 simulations of the converse glide path or reverse glide path would look? Now I'm going to show you what it looks like. Now, the only obvious difference is this one's in green. The other one was in blue. But superficially, they look awfully alike, don't they? Even though this is the absolute converse of the original glide path. So let me overlay them to see just how the same they are. So now in blue is the glide path, and green is the reverse glide path. So except for the little bit of variation you get even with 100,000 simulations, these two are the same. The glide path really hasn't affected anything in terms of the distribution of outcomes. So you might say, well, what if we didn't use a glide path at all, but we simply kept the mix constant at whatever the average equity content of these glide paths was, and in our example, the average is 50. So we could say, let's look at 50-50 and see how it might be different from either glide path. So now we have three lines, three vertical lines at each terminal point, where the rust-colored or red or burnt umber, whatever you might see it as, is now representing 50-50. Well, 50-50 does look a little bit different, doesn't it? It's more peaked and has less at the extremes. And if you want to look at the averages, you'll find that the average terminal value is essentially the same for each of these. The only thing different about them is that the constant glide path, or the level glide path, is less dispersed. In other words, it's more concentrated. It has less risk. So the glide path, rather than changing the expected outcome, only add noise to the outcome. So what can we take away from this? Well, looking at glide path and reverse glide path having the same distribution causes us to wonder, whether they're such a good idea. Secondly, since the constant glide path produces the same result in expectation and is less dispersed, it might even be better. But perhaps even more importantly, what we see is there's a great deal of uncertainty. And even holding a constant mix is not going to deal with the underlying market uncertainty. So that concludes what I'm going to say about the glide path alternative, except to say that the glide path alternative, although it doesn't seem to do a lot, it might in fact be better than what someone might do on their own, which is to bunch up on equities after they've done well and get rid of them after they've done poorly. So glide paths can benefit against an individual who's likely to be counterproductive in how he might move his allocations. But that doesn't mean there isn't something better that can be done. So now I'm going to stop. Matt, do you have any questions that you can introduce?
Well, one question that we've received in the past about this, especially with regards to these histograms, is that these histograms don't show the effect of contributions. So John or Miguel, would you like to say a few quick words about how adding contributions throughout time affects these outcomes?
Go ahead, Miguel.
Okay, well, hello everyone. This is the first time you hear my voice. And so let me address the question that Matt was referring to. So what happens in all the analysis that John just showed, we were just looking at what happens with $1 that is made at the beginning and then is kept throughout all this investment period. And we look at the final outcome 35 years later. Contributions change the result depending on the riskiness of the contributions. So if contributions were constant over time, the glide path would indeed lower the standard deviation of what an investor gets at the end. However, if contributions are not constant over time, but say they have some volatility because people change jobs, because GDP growth is not constant, then what happens to those histograms depends on how much those contributions vary. If they vary sufficiently enough, then indeed a reverse glide path is going to produce the counterintuitive result. It produces the lowest standard deviation of what an investor gets at the very end. So contributions matter. Which direction they matter depends on how variable those contributions are, and that's I should add, that's something that is individual for each investor. Some investors probably will have constant contributions. Others, say particularly people in the finance field, are likely to have very variable contributions. Go ahead, John.
All right. Are there other questions, Matt?
I don't see any yet, so I'll just encourage our listeners to feel free to type in questions as they come to you, and we'll take them at the next break point. So back to you, John.
Okay, thank you. All right, so let us introduce what we feel is a better alternative than the glide path, or one that certainly should be considered along with consideration of a glide path. We'll refer to this as a next generation retirement strategies, and we're going to illustrate one which we think is particularly has merit. And we're going to look at three things, really. It's going to have to protect, it's going to have to capture gains in rising markets, and it's going to have a systematic lock-in along the way in order to limit the regret that can occur if you end up, below where your best point was. And so these are the characteristics we're going to look at. What we call a strategy that we're going to show is called lock and roll, and the reason will be pretty obvious. But first thing in the lock and roll strategy is the selection of a sub-period. We're going to illustrate 3 years. It doesn't have to be 3 years. And each sub-period is going to roll forward to a second, third, and fourth sub-period. at a point that's determined by the actual performance of the portfolio. Up to 3 years, if nothing special has happened, then at 3 years it will roll forward again. The second characteristic that we need to identify is exactly what is it that's going to be the risky asset. The simplest illustration would be, an equity call option, say an S&P call option, and a discount bond. So you have a 3-year discount bond, you take the discount and you buy a call option with it. That would be one illustration. More interestingly, might be the equivalent of that, which is an equity portfolio plus a put option. The equity portfolio could be a managed active portfolio of whatever type an organization felt it was good at doing, plus a put option or a set of put options which were suited to that particular type of investment strategy. So this then establishes the underlying portfolio and a floor value for each subperiod. Now, thirdly, to deal with the high watermark issue, the strategy is going to require a definition of a target value that's set above the initial value of the subperiod, and we'll call that the gain lock level. So this establishes a gain at which point, within the 3 years, if it occurs, we're going to lock in that gain and roll forward. So looked at through time, if the gain lock is hit, the gain is captured, and the strategy is rolled forward, with a nominal 3 years, again, in this illustration. Otherwise, the strategy would be rolled at the subperiod maturity. And at that point, the portfolio value could be somewhere between the floor and the ceiling. But wherever it is, that's the point at which you roll, the value at which you roll forward. And this process continues through time. There's no arbitrary termination. It's basically perpetual. We can find someone with enough longevity to keep it going. All right, just a joke. Now, we're not pretending that the lock and roll strategy is a free lunch of any sort. What we're doing is rearranging, the instances in which people do well and the instances in which they do less well. In a linear strategy, it's always the same. Yet we do know that people are more concerned about losses of a given magnitude than they are about gains of an equivalent magnitude. So always carrying the same risk regardless of your circumstance is not behaviorally sound. So how does this lock and roll strategy, where does it give up and where does it gain? So what we're showing on this picture in red is a 50-50 stock bond portfolio. So its value is along the vertical axis. The value of the stock index is along the horizontal axis. So it's just basically a linear line with a slope of like a half. The blue line shows the sub-period characteristic of the lock and roll strategy. So it has a floor until the market gets to a certain level, and then it begins to capture, and it captures, as you see there in this blue line. So what you see is that over a range around the middle, you're better off with constant 50-50 strategy. For very poor results on the left, you're much better off with a lock and roll. Very good outcomes, you're much better with a lock and roll. So the benefits of this strategy come in periods which are poor and in periods which are very good, and you pay for it in middling periods. So let's take a look at how it might have done. And here we're looking at a strategy that parameters of which are a 90% floor and 110% gain lock. So if you began at 100, your floor is 90, if you hit 110, you're going to roll forward. So what are we looking at here? And along the vertical, it's a log scale, and we're looking at the gain in either the lock and roll strategy, which is in blue, or the 50-50 strategy, which is in green. This begins the beginning of the year after the big crash of '87, so as to not take advantage of that unique 1 year. And it runs up to the end of last year. So it's 24 years. And what are we looking at? Well, the green is pretty simple to explain. It's simply a 50-50 strategy. And it's rebalanced quarterly. And over these 24 years, it had a 6.92% rate of return. Now, the more interesting, in our mind anyway, hopefully in yours, is the blue. So what you see in this sort of staircase is the floor that is in place at any point in time for the lock and roll strategy. So we begin, let's just call it 100 rather than on the left scale, and so 90 is the floor. And it turns out that before 3 years went by, we actually hit the ceiling or hit the gain lock. So the first little kink, or the first step, you might say, shows the floor going up, by 10% from 90 to 100, or not 10%, but from 90 to 100, and then rolling forward. Well, turns out the market was in a very aggressive up period at that time. So the next horizontal spread is quite small because the gain lock was hit again, and then it's hit again after a very short period of time. Then a reasonably long period of time happens before there's another lockup, and so on through the history of these 24 years. So the 24 years actually have within them, and I didn't count this, and maybe Matt, you can while I'm talking, how many actual subperiods there were. But this illustrates, how a lock and roll strategy works. And we actually have a data series that goes all the way back to 1960. So let me show that as well. And you see a rather similar result, although the detail is hard to capture in such a long period of time. It's 52 years. But the general characteristic of it is that you avoid big losses and you capture substantial gains, not all the gains, obviously the S&P 500, but a lot better than a roughly equivalent static portfolio of 50-50. So this all sounds good in theory, but can a lock and roll strategy be implemented on large scale in practice? And the answer, not surprisingly, or we wouldn't be doing this, is absolutely it can be. And not only can it be, but it was. And so what I'm illustrating here is an actual $250 million fund, which was called the Growth and Guarantee Fund. It was sponsored by one of the 3 largest broker-dealer in the United States, and it was managed according to the lock and roll strategy. It was managed by Leland O'Brien Rubenstein, and it was just like the strategy I showed you, but it had a maturity of 1.5 years rather than 3 years. And so this is the trace, and you see it over this particular 11-year period. It did almost as well as the index itself, which is surprising, and except when you take out the fees, and since this was and still is one of the 3 largest broker-dealers, it's not surprising the fees are noticeable. So with that, I think what we have done can be summarized that Glidepaths may in fact be better than what someone would do for themselves, but they do have severe path dependency and regret potential, and leave a lot of uncertainty for retirement. The lock and roll strategies offer a mix of gain potential, capital preservation, limited regret that many investors would find preferable, or preferable either in entirety or as a supplement. And now I want to stop again for questions before we issue the call for action.
Okay,
Matt?
so we got one question from Larry Edwards, who asks, in the cash plus call mode, the floor for each sub-period is assured by the maturing discount bond. In the stock plus put alternative, how is the floor assured?
Well, the floor is managed. It's hard to say it's assured if you think in terms of a guarantee. It's assured by the value of the put. It's not perhaps of the same quality guarantee as the bond would be, the discount bond certainly, but it's AAA quality if the put was from the or resided on the CBOE. So the put provides the floor in the stock plus put.
Okay, and if there are no other questions, then we'll continue from here.
Well, Larry may have a follow-up question, because if anybody knows more about this, or many people know more about this than me, but nobody would know more about it than Larry. Want to extend any further question, Larry? Want to push your blue button there and raise your hand? Okay, we won't embarrass Larry. So we want to thank you for participating in this webinar. This is the first one we've done. I hope it was useful to you. And we want you to let us know, if we can be helpful to you in looking at investment strategies of this general character to expand the set of retirement solutions that you're offering to your customers. And you can do that either by contacting me at the email address shown, or by going to our website. You can contact us through that.